In the 1600s, that is about 400 years ago, the Europeans relied heavily on marine trade, and they were exposed to many perils of the sea such as bad weather, pirates, which resulted in losses. The group of sailors, merchants and ship owners used to get together in the Lloyd's coffee shop every day to discuss their rising concern over losses. The idea which came from their many rounds of discussion was perhaps they should each share the risk by contributing certain percentage of loss. Out of all the voyages, only few would suffer a loss, but no one knows who that will be. So, what they agreed was to compensate those who will suffer a loss on a voyage by equally contributing to a pool of money which will cover the financial losses of the merchants. For example, if there were 100 ship voyages in a year carrying goods worth of rupees 1 lakh each, every year on an average 5 ship owners suffer losses, resulting in a total loss of 5 lakhs. So all the 100 owners will get together to contribute 5,000 each to make up for the annual expected loss of 5 lakhs. Ship owners who incurs the loss of their ships are given 1 lakh, which is the value of the ship goods lost from the pool of money. In this manner, the risk of 5 ship owners is spread across the group of 100 ship owners. This is how insurance started, as a concept of risk sharing by way of contributing towards a pool. First, the contribution is known as premium, like rupees 5,000 paid by all the ship owners to create a fund of 5 lakhs. Second, the benefit paid as the compensation of the financial loss is known as the sum assured. Like any ship owner who will suffer a loss will get rupees 1 lakh from the pool. Third, the financial compensation for the loss is known as claim. Fourth, the measure of number of losses in a sample size is known as mortality rate, like loss of 5 ships out of 100 every year, that is 5%. The group wanted to be more accurate in predicting the calculation of the number of losses, so that the premium can be determined accordingly. So, the group decided to expand their benefit to other groups of shipmen too, so that the sample size can be larger for calculating the average. This is based on a mathematics concept of law of large numbers, which states that the average of the results obtained from a large number of trials tend to become closer to the expected value as more trials are performed. If a coin is tossed, the probability of heads is equal to half, that is half. If a coin is flipped a large number of times, the chances of head get closer to half. The accuracy to prediction increases with the increase in number of tosses. But slowly the group realized that there are few routes which carries more risks. So, to be fair to all the contributors of the pool, those voyages will include an additional loading on the premium amount. Hence, the group started assessing the risk of each voyage. This way of accessing the risk and the decision of whether to accept the risk or not is known as underwriting. The process of maintaining records and underwriting each case involves certain expenses. So, now the premium has 2 components. One is cost of providing sum assured and the other is operational expenses. So, slowly the concept of insurance was being formed, and now in the modern times it has evolved from transferring the risk to a group to transferring the risk to insurance companies. Let us summarize the basic terms of life insurance learned from the video. Insurance is a concept of sharing risk by creating a pool of money. Premium is the contribution made towards the pool. Sum assured is the amount received on occurrence of the loss. Claim is the term for financial compensation of loss. Mortality rate is the measure of number of losses in a sample size. Insurance is based on law of large numbers. More the numbers, more accurate the prediction of losses. Underwriting is the process of assessment of risk and taking the decision of accepting or rejecting the policy. Premium has primarily 2 components: cost of providing sum assured and operation expenses.